Hi. Let's learn about laddering. In finance, laddering refers to different investing strategies that aim to produce steady cash flow and manage risks. The most common usage of laddering is in retirement planning, where it involves buying multiple fixed-income financial products of the same type, such as bonds or CDs, each with different maturity dates. This allows investors to spread their investment across various maturities and obtain ongoing cash flow as they manage interest rate and reinvestment risks. The practice of laddering in retirement planning, particularly in bond laddering, helps investors manage interest rate risk and reinvestment risk. By creating a bond ladder, investors purchase a series of individual bonds, each maturing in a different year. As each bond matures, the proceeds are reinvested in a new longer-term bond, maintaining the ladder's length. This strategy can help reduce interest rate risk and manage reinvestment risk, ultimately helping to preserve investors' capital. Laddering is also used in the underwriting of initial public offerings, where it refers to an illegal practice in which underwriters offer a below-market price to investors prior to the IPO if those same investors agree to buy shares at a higher price after the IPO is completed. This practice provides unfair advantages to insiders at the expense of regular investors and is therefore prohibited under U.S. securities law. For example, Michaela, a diligent investor saving for retirement, creates a bond ladder by investing $500,000 in bonds of different maturities. As each bond matures, she reinvests the proceeds in a new bond, managing reinvestment and interest rate risks. This strategy allows her to expose to interest rate risk only when she has to buy the new bond and potentially lower reinvestment rates by buying longer-term, higher interest rate bonds. Investors ladder bonds to take advantage of the fixed income cash flows they offer when held to maturity and to manage market price risk and reinvestment risk. By reinvesting proceeds from each maturity back into longer-term bonds, investors can maintain a steady cash flow and reduce the impact of interest rate changes on their investments. Here are 4 key takeaways. 1. Laddering is a financial term commonly used in retirement planning to reduce interest rate and reinvestment risk. 2. Laddering is also used in the securities underwriting market to describe an illegal practice that benefits insiders at the expense of regular investors. 3. A bond ladder is a series of bonds with particular maturities that are each held to maturity and whose proceeds are reinvested in new, longer-term bonds to maintain the ladder's length. 4. Bond ladders are used to generate fixed income cash flow and manage certain risks. Hope this would help. Thanks for watching.